Second, dividend yield. I mentioned this, but it's worth repeating. A Canadian dividend aristocrat might pay 4% safely. A UK bank might pay 5%. An Australian telecom might pay 6.5%. These are real yields on stable, established companies. You cannot get that in the US market without taking massive risk. The dividend yield gap is the single biggest reason to go international. Third, and this is critical, currency diversification. I know, you're probably thinking, but currency risk. Here's the thing. The US dollar won't be strong forever. In fact, we're in a long-term structural situation where the dollar is likely to weaken over the next decade due to massive government debt. When that happens, investors who have some portion of their wealth in other currencies, especially in dividend-paying assets, are protected. You're essentially hedging against dollar weakness while getting paid to wait. Now, let's talk about currency risk because this is what's been stopping you. Here's what most people don't understand. There are two types of currency exposure: unhedged and hedged. Unhedged means you're completely exposed to currency fluctuations. You buy a stock in British pounds, and if the pound falls 15%, your dollar-denominated returns fall 15% too. That's the scary part. But here's the solution: hedged ETFs. Hedged ETFs automatically eliminate currency risk through financial instruments called currency forwards. What that means in English, the ETF manages the currency exposure for you, and you get paid the dividend yield without any currency fluctuations. It costs a tiny bit more in fees, usually 0.2% or 0.4% annually, but that cost is absolutely worth it for sleep-at-night investing. So here's the framework. If you want international dividend exposure without currency risk, you use hedged international dividend ETFs. That's it. Problem solved. Now let's build your actual portfolio. Here's the step-by-step method. Step 1. Choose your allocation. I recommend beginners start with 70% US, 30% international. This gives you significant exposure to global dividends while keeping the portfolio familiar. More aggressive investors can go 60-40 or even 50-50. What matters is that you're diversified. Within that 30% international allocation, I recommend splitting it 50-50 between developed markets, Canada, UK, Australia, Europe, and emerging markets, Mexico, Brazil, India. Developed markets are more stable. Emerging markets offer higher yields. Step 2. Select your vehicles. For US dividends, you can use any dividend-paying stock or HD or DGRO if you want ETF simplicity. For international developed markets with currency hedging, your best options are IDHD, iShares Currency Hedged International High Dividend ETF, or DBMF if your broker carries it. For emerging markets, IEMG is solid but unhedged. Only use this if you're comfortable with some currency exposure or size it smaller. Alternatively, EEM is broader emerging market exposure. Step 3. Automate it. Set up a monthly or quarterly purchase plan. Every month, $500 into your US dividend holdings, $200 into IDHD, $100 into IEMG. You pick the amounts based on your allocation. The key is consistency. Dollar cost averaging eliminates timing risk. Step 4. Reinvest dividends. This is where the magic happens. Set your dividend payments to reinvest automatically. That way, every dividend gets reinvested immediately into the same ETF, and you're compounding on top of compounding. Let me show you a real example. Say you have $100,000 to invest across a diversified dividend portfolio. Here's how it breaks down. $70,000 into US dividends. We'll say $35,000 into SC US Dividend ETF with a 3.3% yield and $35,000 into individual dividend aristocrats like J&J, PG, and KO for diversification. $20,000 into IDHD, International Developed Markets, currency hedged. This gives you Canadian banks, UK utilities, Australian telecos, all paying 3.5% to 4.5%, completely protected from currency swings. $10,000 into IEMG, emerging markets. Higher volatility, higher potential yield, some currency exposure. You're taking a calculated risk here, but it's only 10% of the portfolio, so it's manageable. Day 1. This portfolio generates roughly $2,650 in annual dividend income. That's $221 per month, automatically. It's not life-changing income yet, but in 10 years, with reinvestment and compounding, this becomes a completely different number. We're talking $4,000 to $5,000 in annual dividends, and the principal keeps growing. Before we wrap, let me address the question I know you're thinking. Where do I actually buy these ETFs? Vanguard, Fidelity, Schwab, they all have them. You open a regular brokerage account or IRA, fund it, and search for the ticker symbol. SD, IDHD, IEMG. It takes 5 minutes. The friction is gone. The real question is, are you going to do this? Because here's the truth. The difference between a 50,000 portfolio earning 2% yields and a globally diversified 50,000 portfolio earning 3.2% yields is $600 per year. That doesn't sound massive, but compound that over 30 years with reinvestment, and you're looking at potentially an extra $50,000 to $100,000 in wealth. That's life-changing money. International dividend investing isn't sexy. It's not day trading. It's not exciting, but it's one of the most reliable ways to build generational wealth while getting paid to hold. And now you have a concrete framework to do it. If you found this valuable, you know what to do.